Thank you, Justin, and thank you everyone for coming. So welcome to this new edition of the Corporate Strategy Masterclass on governance choices made by or ally. So I just wanted to introduce this series a little bit. So we have been doing this for a couple of years. And so the objective has been to gather a series of 1-hour videos where we have experts discuss main topics of corporate strategy that could be part of a PhD seminar or to refresh your knowledge about the literature or plan for a class. And so we are doing this collection of videos that you can access on our corporate strategy website at SMS on the bottom, and we're working on getting a better organized system for you to introduce in your classes, if you will. And today we are going to add a governance choices class to this. This has been organized by Kathy Magelsen to start at LBS, and now Teresa Dickler and I at the Corporate Strategy. So thank you, Teresa. We could and Katie, we could not have done this without you. And today we have two fantastic scholars to talk about governance choices, and I could not think of two better professors to introduce this topic. Gautam Ahuja at Cornell and Harbir Singh at Wharton. Both of them have published a lot and are well renowned for their research on strategic alliances and acquisitions, among many other things. And so I look forward to the presentation. So we are going to have each of them have a 15-minute presentation, and then we'll open up for Q&A. So without further ado, Gautam, whenever you're ready.
Absolutely. Okay. Good evening and good morning, folks, depending, and good afternoon, depending on where you are situated. Thank you so much for the opportunity, Lisa and Teresa. I'm really looking forward to it, and I do hope you can see my slides, which should now just appear as in full screen mode. And in case you can't, then just do let me know. So I personally think that these are incredibly exciting times for corporate strategy, and paradoxically, in spite of them being exciting times, I just came off a 6-year stint serving as editor-in-chief of Organization Science, and I found that actually very little of this excitement that should be there is actually reflected in actual papers. So my take is this is an incredible research opportunity, and one that I would endorse very strongly. So why do I say it's exciting? Well, again, in the interests of time, my entire slide deck will be available, subsequently wherever this series is housed. The other thing is that I'm going to draw heavily upon, but go beyond my paper with Elena Novelli in the Academy of Management Annals, which looks at desperately seeking synergy and so on and so forth. And you're encouraged to, for further detail on all of this, you could on a lot of this, not all of it, you could go to that as well. Okay, so I think that there are, this is like a perfect storm, except I really need the word which is equivalent to storm in a good sense, of lots of good things happening in the research world as far as corporate strategy is concerned. So first of all, there is, from a phenomenon perspective, you've got this incredible technological change, which has reduced the cost of, information and communication technologies massively. And at the same time, it has made possible, and there have also emerged separately, what we would call demand side complementarities. See, a lot of the literature in corporate strategy was done at a time driven by supply side complementarities, economies of scope and production, R&D, etc. But increasingly, the economies of scope that you see are really coming out at the consumer end, that the consumer likes two services to be together, or mixing two services to be together adds to consumer willingness to pay. And that is what is driving the changes in the scope of the firm. Okay. There are also wonderful theoretical catalysts, because there have been very significant developments in the literature on complementarity and on choice interdependencies. And the related analytics. For instance, one thing that we have almost never talked about in our field is regret theory. And regret theory, in a sense, didn't make that much sense to talk about, because there was no easy way to operationalize or think about it. But the beauty is that with these new technologies, such as we have in the digital world, you get to see not just what people choose to do in many settings, but also what they thought of doing but did not do, right? And that allows us a range of theoretical, extension, which was not possible, or application, which is not possible earlier. There are also significant methodological catalysts in terms of addressing endogeneity and ensuring data availability and tractability. And then you have the incredible amount of new data, which is, like I said, one of the things that's kind of correlated with the theoretical catalyst part. In the past, the only thing we could study was revealed preference, choices actually made by companies. What they could have done, or by individuals for that matter, what they could have done was very hard to assess. But now there are data sets, available, for instance, which allow you to see even things that they consider doing, and so on and so forth, which adds to the excitement in the arena. Okay, so there are basically three core questions that are there. I will only focus on question 1. Question 2 and question 3 will be taken up by Harbir and then also by other speakers in the series. The three questions of corporate strategy, we know them well. Should two businesses or sets of assets or cash flows be combined? That's the synergy question. The second one is the organizational form question. If so, what form should the combination take? Should it be an acquisition? Should it be a partnership? Should it be a licensing arrangement, and so on? And then finally, the governance question. How should that combination be governed? Again, in the past, this was usually only about corporate governance, but now we have platform governance and ecosystem governance also that have been added to this, to the setup. So you can see that this arena has been sort of a very fecund space for going forward, right? And so should two cash flows be combined is the first question. And this debate on does diversification matter is one of the most intense debates in strategy research, yet the results have largely been inconclusive. Yes, no, maybe, all of them are answers, right? And I won't review the discoveries till now later, but I'm going to suggest that there is a problem in how we have studied the problem. Maybe it's not a problem, it's a stage of life in the research cycle. We looked at some things with a macro lens. Now we need to look at things with a micro lens. And this repositioning can be a very, very fecund space or a productive arena for future research. Okay. So broadly, there are two perspectives used in prior research. The phenomenon outcome perspective, which is diversification is a phenomenon of interest in itself. And you want to understand how engaging in diversification leads to a performance. And in this setup, diversification is mainly seen as a one-dimensional phenomenon. Occasionally, you bring in 2 dimensions and so on. But performance is usually evaluated in most papers through an aggregative measure such as firm value or profitability, right? So basically, you have a unidimensional IV and a unidimensional but summative or aggregative outcome on the DV side, right? The bunch of studies of this which have looked at it in various ways, and they've gone the usual pathway of, is the relationship linear, non-linear, are there contingent factors, are there issues of methodology which are causing us to see things, and all of that has been done. What I want to focus on is another element, but before I go there, I want to touch upon what I would call the theory-based perspective too, which is now in this perspective, diversification is viewed as a manifestation of the theories of the firm, right? It is a realization of the theories of the firm, and you want to understand why diversification occurs in the first place. So you don't want to just look at the performance part. You want to understand the antecedents. And the case I'm going to make is that both these things need to be put together to reach that third stage of the research that I'm talking about, right? Again, a variety of theoretical perspectives have been used, from organizational learning, agency theory, evolutionary economics, competitive positioning, institutional theory, and all of them have their own, explanations of why diversification occurs, or and so on and so forth. But again, I'll leave this to your study later on, but I just wanted to establish the idea that these broad theoretical perspectives are brought to bear. And here the thing is, diversification is seen as a manifestation of these theories, but the issue is really on a specific definite set of mechanisms, but all other mechanisms are kind of ignored. And let me explain that a little bit. And correspondingly, the test that is imposed is that at the aggregative level, is market value increasing, or is return on assets increasing, with diversification. But when you recognize that this aggregative mechanism is capturing the effect of many, many micro mechanisms, which may have different weights across different industries and combinations of firms, you're really testing some very hard to even understand joint hypotheses when you do this macro regression of, here is how corporate scope has changed and here is how performance has changed. So let me elaborate on this. Okay. So what I'm going to suggest is two core principles of future research, which is, don't focus on mega outcomes. As we'll see in a minute or so, there are a bunch of micro mechanisms at work, and some of them are in conflict with each other. Some of them reinforce each other. And when you put all of them into a single measure of, corporate scope, and then say this is the underlying mechanism driving it as some broadly termed synergy, we're getting a mix which is, not very, very helpful in that sense, or not very accurate in terms of the underlying mechanisms, etc. So the idea here would be a change in our lens, and that involves a change in the research design, which is you focus on precise micro mechanisms that connect a given form of diversification to a given subtype of performance. And we focus on specific approximate outcomes as opposed to overall corporate performance. So let me provide you with a few sort of illustrations of this side. See, just to give you the idea that there could be conflicts as well as complementarities here. So the most common one is sort of micro mechanism is horizontal operating synergies, right? You share some asset or operations across companies, across businesses. But that has, again, sub-mechanisms. These could arise because of economies of scale and scope on the cost side, and willingness to pay complementarities on the demand side. And it's not clear that the same diversification move will affect all of these in the same way. It could affect, very likely, it will affect costs in one way and willingness to pay in the other way, right? If you try to cut costs, it's a fairly, logical thing that you're going to have some potential effect on willingness to pay, which might be negative. So it's not clear where that outcome should eventually end up in. Similarly, you have vertical operating synergies, which is about conducting the activities of two successive stages of value chain within the same company. Again, this could have both cost and willingness to pay side things. And the other thing to keep in mind is that there are simultaneously diseconomies of scope, and that may also be arising. We have a more complete listing further on, but the core idea is economies of scope don't just arise because you put two businesses together. You have to invest in mechanisms to combine those two businesses, right? But that also taxes the attention of the managers on top, and so on and so forth, right? So the core idea here, and again, this is just a broad, this kind of elaborates all the various kinds of things that the literature has already found, right? You have good coordination costs, attention costs, contagion costs, compromise costs, integration costs, and so on and so forth. And the catch here is, therefore, what we really need to be thinking about is, in some senses, figuring out how these micro mechanisms relate to each other and so on. So again, I've That literature is also advanced, but nowhere near where it, how far it could go. I'm not going to get into individual, articles here, but you can see that many of these individual things have already been explored or touched upon. But this micro mechanism is really the path to kind of be focusing on. And so let me go to one broad question like this, and then I'm going to get to the specifics, purely a time-related thing, which is that, for instance, we know that technology has changed the boundaries of the firm in various ways. We can see that around us, right? Amazon is far more diversified than any company in history before it, in some respects. Similarly, Google, Microsoft, Apple, or at least Google and Microsoft. And at the same time, theoretically, it raises two questions. Does technology reduce coordination costs and increase the diversification carrying capacity of the firm? In other words, the same firm can have a much broader scope, as Amazon would have us believe. Or does it reduce market transaction costs and the optimal scope of the firm again, in the sense that it becomes easier and easier to coordinate across markets? The problem is they're both likely to be true, but under a different and yet to be discovered set of conditions. So that's the kind of thing that I'm focusing on, is that we need to be looking at. Okay. So what are some of the underexplored areas? Demand side synergies and their effect on corporate scope, not yet studied. Supply side, we did a lot of, right? Innovation diffusion and its effects on corporate scope, not yet studied as much. The innovation generation has been studied a lot. We studied product innovation as it arises or gets related to corporate scope, but process innovation and corporate scope is yet to be focused on internally, both in terms of identifying synergies and this thing. We've also focused tremendously on what we would call embodied innovation in corporate scope, but other forms of innovation are not yet explored. So you've got another arena there, right? So just to sort of flesh it out, I won't have enough time to go into a provocative. So what I try to do is build a little hypothesis kind of thing for you with an illustration, is that notice that between 2000 and 2020, I'm going to the last column here, the horizontal scope of service-dominated businesses expanded considerably. See Google, Microsoft, Amazon, etc. But over the same period, the vertical scope of these very firms actually decreased sharply. And also, vertical scope more broadly decreased sharply. So consider companies like Genpact, TXL, WNS, Shopify, Wix, Weebly. These are companies that didn't exist earlier, Twilio. And these are the companies that are providing sort of the back end of these, the vertical back end of the companies that we have, right? And the interesting thing here is that this innovation creates scale advantages across client companies. That's why Amazon can become very big, but it's focusing on certain vertical slices only. And at the same time, the scale benefit also applies to the other players in the vertical chain. So what you're ending up seeing is massive slices of scale in individual vertical, in the individual slices of the verticals. And what you're seeing in some respects is the emergence of megaliths at each stage of the value chain. So in a given value chain, you're seeing a lot of expansion in size at each level by individual firms, but then you're going towards this world of these, large firms competing with each other vertically rather than horizontally, because horizontally those markets are becoming very concentrated anyway. So these multiple industry spanning behemoths raise a very, very interesting perspective. And for those of you that have not gone back and read Scale and Scope by Chandler, I would suggest you go and do it, because in our lives, we are reliving it, but in a different form. And it is for the scholars here who have to tell us, how is this form different? And interestingly enough, the original companies underlying Scale and Scope were things like Ford, for instance, were huge vertically integrated behemoths. Guess what Ford is doing right now, and General Motors? They are actually reducing scope, right? So in terms of vertical scope. So the idea here is this process is rhyming with that early 20th century thing. As they say, history rhymes, but doesn't necessarily repeat itself. I'm out of time, I presume, so I'll stop here. But there are, similarly other questions in the setting. So I'll I'll pass on those for now, but you will obviously have them with you later on. Okay, am I correct on the time?
Perfect. So thank you so much, Gautam. Well, Harbir, can you unshare slides, please?
Oh, yes.
So, while Harbir sets up, so thank you very much. It's very interesting thoughts. Just to so I just wanted to encourage the audience to, if you want to start putting questions on the Q&A, and once we get to the Q&A section, will allow you, give you a chance to talk. Okay, Harbir. The floor is yours.
Thanks very much. And Gautam, thank you for a very inspirational first part. Delighted to hear all those wonderful ideas. I actually agree that it's a very exciting time, and it's always been exciting in corporate strategy. But with the current ongoing, the current version of the ongoing debate as to does corporate strategy matter, and what are the sort of optimal boundaries of firms? Are they steadily exploring different boundaries, and so there are different experiments in parallel? But I think the issue of does corporate strategy matter is now very much in the camp of it matters very much, because if you think about the biggest moves that companies make, and this is also something that consulting firms have noticed, that the where to play is a much bigger variable explaining performance than how to play. And that is rapidly in evidence, and even in Gautam's presentation about technology and other factors changing the question of scope, and then companies experimenting with what level of scope they want to be in. What I'm going to do is talk about modes of growth, but I will not talk about all modes of growth. I'll talk about selected modes of growth, just to sort of give a flavor on how to proceed on this very, very interesting domain. So if you think about, 1 second, if you think about the spectrum of interfirm relationships, you have, long-term contracts all the way to acquisitions. You have the whole spectrum, non-equity alliances, equity alliances, and joint ventures, corporate venture capital, minority stock investments, and acquisitions. And this, of course, you still have organic growth. The interesting thing here is that a couple of places have really, a couple of domains in this spectrum have really taken off and need more direct attention. One of them is actually corporate venture capital. This has been growing for the last 10 years, and is really a sort of a corporate version of venture capital. And the idea is that firms will invest in a more narrow set of industries that are closer to their scope of industries, where they can provide complementary assets. And then however, they'll try to benefit from the energy and ideas of entrepreneurs. Entrepreneurs will benefit from possible complementary assets, but have similar incentives that they do with a regular venture capital investment. And initially, this was not growing so fast, but in the last 5 years or so, it's grown dramatically. Again, the experiment is underway, so it's not clear how it will eventually play out. But many companies like Intel, Johnson & Johnson, many others are investing, as much as $500 million to $1 billion in corporate venture capital. So this is a very significant trend. Similarly, Gautam already noted the point about ecosystems, which would be largely non-equity partnerships, and they have completely exploded in some domains. And so, by the way, ecosystems always existed. It's just that now the unit of analysis of ecosystem has become significant. In fact, speaking of Gautam's historical point, before the rise of the diversified corporation that Chandler noted, you had the mercantile kind of approach. So you had actually traders and other contractors working with each other. But now with this new set of technologies, the nature of scope economies has changed. And so this is once again an experiment. So if we sort of look at acquisitions and alliances as two of the elements of the spectrum here, I think it's useful just to dive a little bit more deeply into them. And I kind of chose attributes that are reported by research. I've not actually done sort of topic by topic citations, but you can see that the difference really is in acquisitions you're purchasing the right to control, whereas in alliances you're negotiating control. So there's a question of whether buying control in the market for corporate control is appropriate and at what premium. One of the areas that has not been studied as much and is really important, and it speaks to what Gautam was saying, is interdependence of activities. And this is a place where strategy concepts can be really important. To what extent is interdependence sequential? To what extent is it reciprocal? So to what extent is it modular or pooled? And does the governance structure actually link to that nature of interdependence? Similarly, again, back to micro mechanisms, you could think about hierarchy as a way of managing overlapping resources versus influence as a way to manage resources, and how you might think about allocating resources and getting coordinated activity through that. Acquisitions are less easily reversible, alliances are more reversible, and again, you have the nature of uncertainty in both cases. There's also the interesting point, I think, that I don't think has been used as much in the strategy literature is the idea of the market for corporate control and the notion of competition for resources. And when competition for resources is high, again, there may be a need to buy control, even if it is not entirely proven. And that may explain some of the tech acquisitions we are seeing today. And then the point really is building capabilities and routines using an evolutionary view of the firm. If you look at sort of abnormal stock returns associated with alliances versus acquisitions, what you see is that actually alliances perform quite well on the studies that have reported abnormal returns. It's about 0.76% that I saw. I think there may be more additional studies that will report in. But multiple single bid acquisitions are higher in value, but multiple bid are lower. And you can look at this and say that bang for the buck, alliances may actually be attractive. And that's something to think about. And so the ecosystem relationships, many of which are, lower commitment alliances, may be a way to sort of access resources for strategic purposes. Another lens that we can look at is an option-based lens. And this is sort of in the notion of, in the domain of technological and demand uncertainty, that in high uncertainty, one would think about, from an options point of view, a learning approach, a window into the technology. And as the uncertainty resolves, a real option approach to uncertainty. And then as it resolves even more, then maybe a scale-based response to uncertainty. And I think the interesting point is, for different technologies and different product markets, these cycles are going in different stages. And so firms and decision makers, the question we have to ask is, an interesting research question, is what is the portfolio of strategies that you're adopting? How many of their transactions are window-based? How many are options-based? How many are positioning-based? And do they in fact have capability in all those domains? So these are, I think, very researchable questions. And taking Gautam's point, I would say one could define a particular industry and look at how participants in the industry are using weighted combinations of these three different strategic choices. I have a little bit more elaboration here on sort of the window and the options and the positioning strategy. And this is from a book chapter that I had put together with Jeff Dyer. But it's just one idea. And there's other work on real options and alliances by Tim Folta, Jaideep Anand, and many others. And that work actually talks about also alliances as stepping stones, but then it's, and there's some evidence that in fact, the performance of acquisitions is enhanced by pre-existing alliances, actually more in the cross-border area than in the domestic area, interestingly enough. But these are again areas for research. And certainly, if you look at field-based examples, you see some companies actually adopting partnership before acquisition. So specifically on the choice between acquisition and alliance, I want to take want to highlight just a way of thinking about it. This is based on integration of the literature. You could think about the rows are really interdependence of activities, the nature of resources, tangible versus intangible, the nature of redundancy, the degree of market uncertainty, and the level of competition for resources. And using evidence from the field and research, one can think about specific on the right hand, the rightmost column, choices of governance, equity, non-equity, and acquisition. We just take three of them, and I think that is largely backed up by literature, but there's more work that's needed as you add the ecosystem idea with much more transient connections. But I do want to point out something theoretically that's important, and that is, if you look at the last row on competition for resources, this is much more at some level competition in factor markets and also competition for entire firms. And so we have to be careful. When I see people talking about these choices, they're not fully acknowledging the markets in which you're accessing these resources. What's the nature of the factor market? How perfect or imperfect is it? What's the nature of the corporate market as a whole? Are there available targets or not? Enough available targets or not? And that is the case in biosciences and so on. You don't have integrated firms as much. You have more today than before. So we had lots of alliances. Back to the window options positioning approach. So that's an important point where we have to be clearer. The second place where we have to be clearer is, and this is a real opportunity, the concept of interdependence is something that is very relevant in strategy and particularly ties to delivering value. And one of the ways is to think about classic definitions of interdependence, modular or pooled, sequential, and reciprocal. But if you look at NK modeling as an approach, you can actually model any kind of interdependence. And so this is an important area where we can shed a lot of light into, and of course the hypothesis would be that low interdependence would be very much contractually based, and lots of cross correlations between activities between the transacting parties would probably point towards hierarchy, and we can ask whether that indeed is the case or not. So that's something to think about as a research question. And this is what I have here in my next list, which actually is the rows of the table that you just saw. And the last bullet point here is transactional competence. There are consulting firms that actually are renting playbooks for these transactions, and companies are playing. So just by existence, it seems like playbooks matter. And I think in strategy we have not really acknowledged that as much. We tend to think that it's just number of transactions because that's researchable. But it might be good to look at, I think from field-based research, to look at playbooks that firms use, whether internally or through partnerships, even if it means a more granular piece of work. This is, I think, a very high value potential opportunity. And it comes into the choice process because my playbook may be geared towards partnering, or my playbook may be geared towards acquisition, or it may be geared towards network relationships. And this requires more granular research. But given how much effort and energy and dollars are being spent on this, there's at least a sense either everybody's misguided or there's something valuable here. And this was an example. We did some field work. Prashant Kale, my co-author, did some field work on partnering capability and saw the importance of the alliance function on the top right-hand corner, and then various processes of knowledge articulation all the way to internalization in partnering activity. And I know people have looked at that. There are some recent researchers have looked at divestiture also, and whether learning from acquisitions spills over into divestiture. Does learning from acquisitions spill over to alliances? Jeff Ryer has worked on that. So this is an area that's very promising for doing research on spillover between modes. And this is an example of knowledge articulation. I'm just going to look at time and speed up a bit. This is sort of the playbook for alliances. And with that, I just want to go back to this continuum and say, an approach would be not to boil the ocean and look at all these things together, but do some pairwise comparisons where they make sense. And it's actually important to drill deep as well, because we haven't really established deep knowledge about the capacity to manage these transactions, and also some of the key success factors in different types of transactions. So in opportunity research, again, deep dives into decision process. I think Gautam's point about micro drivers of value is absolutely critical and central. Um, I think Gautam's presentation overlapped with mine on nature of resources, synergies, and activity interdependence is something that I think is really important. Um, and then use of simulation-based models. I want to advocate for that, because there's a limitation of data, and we can, with sophisticated simulation, get quite far down this road on choice of governance mechanisms. I wanted to just say a little bit about the classroom as well, and I'll just say that it's a great time to be working on corporate strategy, because it is a central question that students know is important, and we can speak more about that. With that, I'm going to pause, turn it over back to Elisa.
Thank you, Javier, and thank you both of you. This has been really eye-opening and a lot of food for thought. One thing that one message that I think you both are giving is that at the same time there is a change. So for us, the PhD students are looking for new topics, or new researchers are delving in. There is both at the same time new data and new phenomena that allows us, so new data that allows us to look into previous, like older phenomena in a different light, but also new phenomena that may open new theoretical questions. So I thought that was very interesting. I don't know if you want to comment a little bit more on that. I know it's very general.
Yeah, I can start. I think great point. These are very high stakes issue. For example, to Gautam's point, activist investors are, I think at least there's some research that shows that more than 50% of the S&P 500 have had some activist investor activity in the last 5 years. So there's a lot of, and the main question they're pursuing is scope of the firm, the boundaries of the firm. And this is, there's a lot of research in finance, some in strategy as well. Emily Feldman and others have been working on it. In finance, there are other pieces of work as well. And that's an example. So what is the right scope of a firm? Are people leaving value on the table? I think is an important and researchable question. But having said that, new phenomena like corporate venture capital have grown explosively. And it's not just technology, it is actually consumer products and so on. So this is an opportunity for us to, back to Gautam's point, a revolution of Chandelian scope here. How do we look at these new structural forms, and how do we think about why they exist, and why are they arising? So anyway, those are just some. But I will say also the role of simulation. I think we have had a paucity of data. We have a lot of researchers in the room, and getting good data. I think sometimes the customized data sets take a long time. Having multi-method approaches, including some part of the research being simulation-based, I think is an important way to advance the field.
At least I'll add a very quick this thing to it, and this comes from my own perspective on seeing papers being submitted for the last 6 years for org science, at least in I have a 100% sample of that. And my take is that we are seeing, as often happens in all our fields, we engage in local search. When something has worked, or you see something as a trend, everybody hops onto it without paying attention to the fact whether or not the most important questions are being addressed in what they have in mind. So right now, everybody wants to do a field, experiment, right? But many questions are not amenable to field experiments. And if they are, then they're not generalizable beyond the internal context. Similarly, you're seeing a lot of work where people are saying, I found a data set. Now let me find something in this data set, even if it has very little to do with strategy, as long as I can make an empirical case that this is a true empirical finding, hopefully somebody in the journals will accept it somewhere, right? And I think that stepping away from what if we're just going to become pure empiricists who will just take any data set and come up with some questions and, which are of very, very marginal, this thing in our own field, the importance in our own field, one, it's not going to be very impactful work because nobody in our field are going to build on it. But the bigger danger is we'll be doing that work poorly, because as I saw, lots of people would say that, here is something I studied and this is, and they put it out there. And these are, very well executed studies, except for one little problem. They're not in the field of strategy necessarily. And sometimes they're in fields where, people are then asking in those fields that there's a lot of context knowledge in a field which the strategy reviewer does not have, or the organization science reviewer does not have. But when that paper eventually hits somebody who has worked in those fields, which are outside, in some cases, even the business world, they're immediately saying, but this is the most trivial thing. We've already been through this long time ago, and your guys are now publishing it now. But and so that's the kind of thing I want, is that look at the questions that need to be answered and then think of where it is. Don't look at the lights, where the lights are, and start looking for the keyring. Look where you lost the keys in the first place.
I think that's a great point. I would just add that the question of reviewer base is really important. I think because there's been a groundswell of interest in experimental work for various reasons, and I don't think the reviewer base in strategy is connected to that. And as you said, when it goes to reviewers in the methodology, they don't know the questions we're asking. So you have this problem, and I think there's some parallel element there in simulation as well. We don't see that many papers using simulation. I have had a couple of simulation-based papers, and I didn't think that for other submissions that they seem to, that there's no clear tradition on how to do it. There's many different approaches, and maybe that's the domain of special issues. But again, that's fine. All innovation has some challenges with respect to reviewer base. I would say that what you were raising, and a stronger version of that, is maybe taking questions that are clearly very, very important and working on them with the best method possible, is probably most appropriate method possible, is a way to have a better chance of having impact, right? Because just doing local search, taking an existing method, it might even make it, but then cumulatively the other work will have more impact. And we have some really, really big questions, and I'm confident there'll be people working on them. And this is just a subset. I mean, the questions that we are raising here.
So I wanted to open it up to the questions from the audience. So I see Roberto, you posted a question. Do you wanna speak? Justin, can you give him access to the mic? Or if not, I'll read it, but. Roberto, okay. So I'll go ahead and read, but feel free to jump in. So Roberto was asking, Harbir, do we need to incorporate types of interdependence among economic? Justin, can you look into the mic?
Yeah, I saw.
So basically,
in the
text.
question,
yeah.
I think it's an excellent question as to whether what would be definitions of interdependence that we could use in contexts that we see more complex, such as political, social, as well as organizational. And I would say that there's a lot to be done on the organizational side itself, just to make it tractable. So that would be a place to start. But for and do a good job with that. But particularly inter-firm relationships, I think the notion of network linkages becomes prominent. Indirect connections. In fact, Gautam, you've done work on direct and indirect ties, right? And there's a interdependent element to that too. So looking to find what's measurable in interdependence is important. What I found was even pooled, sequential, and interdependent was actually interdependent was actually quite useful. But excellent point.
So if there are more questions, feel free to leave them on the Q&A or ask Justin to open your mic. In the meantime, one thing that you guys both have talked about is refer to the different objectives. So we typically talk about performance, or we talked more about performance as a monolithic variable before, but there are different aspects that we need to consider. So Gautam was talking about unpacking these different objectives that sometimes maybe one against the may not work on the same direction. Harbir was talking about how these acquisitions and alliances may pursue completely different objectives, which in the end may lead to performance in different ways, no? So these mechanisms. And I was wondering to what extent this is also an opportunity to look into a bigger conversation that we're having across different fields today about different types of value, and not just financial value, but other values like what the stakeholders care about, sustainability. So if you could comment on that.
Sure, I'll take it on. Yes, clearly, I mean, that even if whatever answer I provide, the field has already provided its answer. It's the number of papers going in that direction or on those kinds of outcomes have been incredibly large. I think in that area, I mean, I welcome the growth in that. I think it's important for us to understand that. But I think the critical question in that area, which is required to help us sort of make broad sense of it, is the interaction between the classical measures of performance, such as shareholder value, and these new requirements that you have, whether they be ESG or whatever. How and when are those, sort of what are the interactions there is something that, is very, very critical, because the point is, theoretically, see, one of the reasons why I think shareholder value has always remained the prime, primus inter pares at worst, and prime generally, has been that it is a clear and unambiguous criterion, right? It's measurable, it's clear. And we do know from the work of Dan and Sendhil and others that when you have companies trying to do multiple things at the same time, there are very, very real trade-offs involved. So I think that arena which looks at how this is affecting and the mechanisms by which it is affecting these two kinds of things. So how does social performance, in a sense, interact with economic performance? I'm not just saying put two dependent variables out there. I'm saying think of the underlying mechanism, right, the approach that I brought out earlier, and see how it may not be even one study. Maybe it's a sequence of studies you have to do. The first you say, okay, in this context, here is how I expect the financials to work, and here is how I expect this to work, because the things that will cause the financials to improve will actually create a problem for this in this specific way. So I think that's the part that needs to be done, because the biggest debate as far as society is concerned is, yes, ESG is like motherhood and apple pie. The catch is, what is the cost, right? So that is the part of it that we have to kind of bring out also. So I think that's a key part of this literature, but it's growing very, very fast from what I've seen. Yeah.
The only one very quick point I'll make to leave time for questions is that this is not an old question. This is actually not a new question as to what's the performance measure. Performance is important in strategy. To some extent, it differentiates a strategy paper from something else. However, Gautam, in your own work, you looked at patent production, right? Creation of patents as a dependent variable. And that's an example of being proximate to the phenomenon. No one debated that that's not a good measure. I think more work should be around these intermediate measures, because the final measure has also lots of things driving it and noise that comes about. The second point, just to differentiate, just to add one quick thing, ESG and others, one place where one can make headway is to think about trade-offs. I think that you can measure, that which ESG mechanisms actually are connected with value creation, and which are neutral and which are not connected or negatively connected. I think that would be interesting. But again, I think the point you made, and the last point I'll make is just about decisions. I think studying decisions is important too. Choosing to partner, choosing to acquire. And that has been a source of great progress in the field because we were obsessed with performance and not the decision itself.
And if I can ask just one last question. So some of the, we have been talking about technology and how this has enabled, so Gautam, you were talking about how there are now different types of, there is a different way in which you can choose your scope and scale, and different ways in which you can pass on information, which is lowering the coordination costs. And so that is related also to these like organizations that are a lot flatter, are a lot smaller. There are startups that are growing quite big, quite of the sudden. So does it change the questions that we can ask? Does it allow us? So what are interesting directions in this, with these like new types of organizations, as we think about corporate governance?
Okay, I'll go first in the interest of time quickly. I think there are different sets of questions here with respect to each of the three components, that the three core questions of strategy. The appropriate scope of the firm, how it is to be combined, which is what Harbir talked about, and then the governance part, which neither of us had the time to get into in detail, which is, how is the ownership structure, et cetera, coming to, change things and so on and so forth, right? And I think all three components of this change have their own kind of, have their own kinds of significance and this thing. And the other part here, which is very important, is that these changes, we could re-examine Chandler's thesis now in this world, but we can also go beyond it in a sense, because now we have a lot of understanding also of how antitrust works, right? Yeah. And so that is an arena that we have not really contributed much to. There are not too many cases that strategy people are invited to, provide insights on how a particular antitrust action should be, what might be the antitrust implications. But here you see that, just to take that one illustration that I had in the interest of time, you're seeing essentially the emergence of very powerful countervailing power in the form of vertical competitors, and almost a much lower competition in the form of horizontal competitors, right? So now, of course, that has also meant that selectively these companies they're also engaging in vertical integration. Normally, vertical integration had led to concerns of foreclosure, et cetera, in a certain way. But now they're bringing out new arguments. This whole dynamic brings out new arguments, right? So if you take a company like Shopify, right, it is if you think of what downstream industry it services, the answer is almost everything in the world, right? But if you think about how big it is and who are the two big competitors competing with Amazon in a sense and providing a marketplace and so on. And so the idea here is that how does this even play out in an antitrust world? We don't have a very good sense because we don't understand the competitive dynamics here. So the point I'm making is corporate strategy is interacting with competitive dynamics, and that stuff, whether you look at it in terms of platforms, Google's claim for protecting itself on an antitrust platform is, hey, I'm not even charging the customer, so how can I overcharge them? Is there any realistic state in the world in which I will be able to charge for search? No, then why are we talking about my dominance in that market? And in any case, I'm not dominant because Amazon is also a search engine. It's a specialist search engine, but it's still a search engine, and so on and so forth. So that's the point I'm making, is that the competitive and corporate strategy distinction should not hold you back from saying, what are the competitive interactions of corporate strategy, implications of corporate strategy and so on.
Yeah. So I have actually just a 30-second addition to that point, that if you look at the smartphone industry, what you see is that there are direct connections between the competitive strategy of the firm and its ecosystem of relationships. And in fact, the success and failure of various manufacturers has been like BlackBerry versus Android, Apple and Android equipment makers, was affected by how the ecosystem was playing into their competitive strategy. And these are measurable, actually, it turns out. So there are places, again, back to the proximate measure, there are places where you can measure with a granular information. It's going to be a short time horizon, but a long time horizon for the industry, you can get a lot of interesting insights into, for example, the nature of interdependence between players and how it affects competitive strategy.
Thank you so much. Thank you very much to the panelists. I mean, I've learned a lot. This has been an illuminating class in terms of what else we can do in this literature, or what are the big questions with impact as we go forward. Thank you to the audience for coming, and thank you to everyone who made this happen. Again, Gary Michelson, Teresa Dickler, the SMS, the office. Thank you, Justin, and the corporate strategy IG leadership. So thank you very much, and I hope you all had a good seminar. Thanks.
Thanks so much. It's an honor and privilege to be here.
Thank you. Absolutely.
Thank you. Bye-bye.